All right, so I think we can get started now. Welcome everyone to the event today. We have guest speaker Joel Stevens here with us today. He is the co-founder and principal of the hedge fund Austin Value Capital. So today he'll be talking about the stages of building wealth, and we should have a Q&A afterwards as well. So yeah, with that said, I'll hand it over to Joel.
Okay. And we can definitely do Q&A at the end, but feel free to interrupt me with questions because this is kind of, I'm going to go through stages and you might have questions about individual stages. So feel free to interrupt. I usually keep it pretty open on what I talk about. So I was talking earlier, but this is kind of a guinea pig type presentation for something I'll give to my kids a little bit later. So I've been thinking about this a little bit. So I threw this together. Maybe a little background on me. I grew up in Texas and I actually grew up somewhat poor. So, started in a mobile home on the wrong side of the tracks in a small town. My parents were pretty good savers. So over time, we moved to better places and education was important. So I went to a magnet school near the Woodlands. It's a Houston area. That was it was Academy of Science and Technology, and then I did a lot of science fair projects. So I won best in biochemistry at the International Science Fair, using DNA to solve computer science problems, NP-complete problems. Then I went to Rice and majored in organic chemistry and published, I guess, 3 or 4 papers. And then I decided that maybe wasn't the best plan for graduate school after the professor I worked for didn't get tenure. And then I became a patent agent. So I write patents largely for Apple. So on how 5G works, it's a lot of standards related patents, LT, 5G, NR, that sort of thing. And it wasn't until I was about, I'd always been focused on saving, but it wasn't until I was about maybe 26 before I started investing in individual stocks and focusing on investing in that way. And then I happened to start around 2010, which was a great time to be a value investor, investing in a lot of hated stuff, mostly the banks, when everything was quite cheap and everybody hated them. And then it's been a bull market ever since, which has gotten increasingly difficult lately. But I worked a lot by the hour. So I billed by the hour, and that's how I made money. And then I just saved as hard as I could to invest it in stocks and some real estate. And that's worked out pretty well. So I thought I'd try to give a presentation on what the different stages are as you build wealth, what it feels like, what sort of things you might want to keep in mind. Now, some of this may be stuff you already know. I wasn't quite sure how much background you guys already had on this. So if it's too slow, then just tell me to move along. Anyway, so I'll just get started. So first, let me get focused here. Okay. So background here, and you guys are probably already familiar with this quote, but it's a Buffett quote. It's hard to go wrong with them. If you don't find a way to make money while you sleep, you will work until you die. And so mostly I'd say what to focus on here. So what's worked in investing is owning equity and cash producing assets. That's worked over long periods of time. Sometimes it doesn't work as well as other things. These days crypto is very popular, but what we focus on is equity in cash producing assets. But that can be a variety of different things. That can be equity in real estate. That can be equity in a private business if you're an entrepreneur. That can be public equity if you're investing in public stocks. It can be private equity, but anything where you own the upside on something that produces cash, as opposed to say debt where you get some fixed coupon or a limited return. And largely that's what's worked. There's a paper. I didn't insert it here. There's a paper that talks about the long-term returns from, and I can post it. Let me see. In fact, I should probably just post it into the chat, although my chat has disappeared. Well, I can post it here in a minute. I'm not sure where the chat went, but it is the returns of everything is what it's called. If you Google it, you can pull it up right now. But it's a compilation from 1871 to 2015, and they studied not just the U.S. but also international. And the two asset classes that worked for the long period of times were public equity, and they just call it equities, and real estate. Now that if you look at real estate just as the price appreciation, ignoring any rent that you could get from it or using leverage, then it largely does not keep up with inflation. You can read Schiller's paper on that. But this paper was trying to incorporate the the rent that you can get out of real estate, and if you include that, and that's not including leverage, which is almost always used, then you have comparable sort of returns in real estate and public equities. Bonds did not work as well, and gold didn't work as well. So this is what we focused on. It's also, in general, what Buffett talks about. So moving on there, when to invest? The answer is early and often. So you guys may have read The Snowball. That was one of the biographies of Buffett, although I kind of like The Making of American Capitalist a little better. But you have this quote down at the bottom. I started building this little snowball at the top of a very long hill. The trick is to have a very long hill is either starting very young or living to be very old. So start as early as you can and keep it going for as long as you can. So I'd say that the first step for figuring out how you're going to build wealth or what your purpose of building wealth is to know why you're doing it and what you're aiming for. For me, the most important reason to build wealth is for independence, so that I don't have to do what other people are telling me to do. I don't have to work other people's hours. And it's just, by and large, a lot more pleasant life if you own the equity in a business rather than being the labor in a business, because when you're labor, you work for whatever hours you work and you get paid for that. So you aren't getting paid in your sleep, as Buffett would say. So if you're thinking about retirement, there's a few things you want to be thinking about. How long do you want to work? Now, some people want to work for a long time because work gives them a lot of purpose and makes them feel good. If you're doing something you love, or you're building a business, that might be where you want to go, and that will affect how much you need to save, how fast you need to save, and that sort of thing. But these are questions that you want to be thinking about. So do you want to retire at 40, or do you want to retire at 50? You want to keep going? How long do you want to go? And that's going to determine the math of your retirement, or financial independence. It doesn't really have to be retirement. And then the second important factor is what level of spending that you need and what level of spending that you want. And something I think that's important to think about, the goal of money is not just to get as much as you can. It's to figure out what kind of life you want and what the money can get you for your lifestyle. I'm sure many of you have read about the hedonic treadmill. So, I mean, humans have a tendency to kind of increase consumption over time. And when you get something new, it feels new and shiny and great. And oftentimes within a few months, it's not that important. You want the next thing. So you have this problem of kind of lifestyle creep, that it's not really making you happier, but it's making you continue to work or keep thinking about those things. So I think it's important to focus on what's going to actually make you happier, what's good for you as a person. For me personally, I like a lot of alone time. I like to be in charge of my time. I like to have an open schedule. That doesn't really cost that much money. It just, you need enough to live off of. Um, so these are the questions that you really want to be thinking about, and it's important to think about them early so you know like what your plans are so you can get towards them. I would recommend in general starting with the more conservative choices, and then you can choose as you get older which ones make sense. So I usually start with, um, what's the least amount of money that I could retire on that would make me happy and independent, and I want to save in a way that's going to get me to that goal as fast as possible. But if I get close to that goal and I'm like, well, maybe I want to spend a little more over here, I'd like to be able to do this. Maybe I'll relax that a little bit and allow the spending to increase. Um, but I try to start with something fairly conservative. So hopefully that makes sense. There's different, and if you look up, a lot of what I'm talking about is FIRE, which is financial independence, retire early, but it's mostly financial independence. There's lots of subreddits on this. So there's like FIRE in general, but there's also lean FIRE. So that's a type of person who's going to try to limit their expenses as much as possible, so that they don't have to save as much. Like I have a friend who lives off about $30,000 a year. So he just doesn't have to have much money in order to do that. He has his own farm and he grows vegetables, um, and he still works because he wants to, but he just doesn't really have to save much for that. So that'd be more in a lean fire area. You can have, I guess, on the more extreme side is like fat fire, and that's where your expenditures be $100,000 or more when you hit retirement. And that obviously requires quite a bit more capital to get to that point, to safely live off of that for an indefinite period, particularly if you do it when you're 40, because you have a long life in front of you. So this is you need to know what goals you really want, so you can work towards them. So the math of financial independence is relatively straightforward. So the original study was the Trinity study. I think that was back in 1998. That's where the 4% rule came from. It basically just took all of the historical time periods and did rolling periods, rolling 30-year periods with different asset allocations. So anywhere from 100% stocks to 0% stocks and all bonds, and then mixtures in between, to see how if you withdrew 4% of, like, let's say you retire, and you have $1,000,000. So the 4% rule would be $40,000 that you could withdraw at year one. And then according to this study, it had a very strict formula, which was regardless of what happens with your stocks or your portfolio, you take out $40,000 the first year, and then you adjust it by inflation each year after that. And so it increases over time how much you're withdrawing. With the 4% rule, you had somewhere like 95 to 98% success rate. So it was only like 5% of times that you ran out of money if you strictly followed that rule. And those situations would be like if you happen to retire at the peak of 1929 and then you had to deal with the next 30 years. So that's where you would have a failure. Now, of course, this doesn't take into effect that a real human wouldn't really do that, because you don't really let your portfolio go down to zero when you need it, because the math quickly stops working. So you might get a job again, you might reduce the amount that you pulled out, that sort of thing. Now, the next series that I would recommend, and this guy wrote, I think, 46 different blog posts on safe withdrawal rates. It's amazingly in depth, and I highly recommend it if you're interested in what a safe rule is. It's particularly relevant for people that want to retire and have more than 30 years in front of them. So for example, I'm other than the hedge fund, I'm retiring from my job pretty soon. I am 39 at the moment. So, I probably have 40 plus years left in me. So the 30-year studies aren't going to be as useful for me. If you extend it out to 60 years, you kind of need to have a heavier stock leaning or heavier equity leaning. So I'm probably going to be 100% stocks the whole time. Bonds aren't particularly fun these days. Um, with that sort of setup, the 4% rule usually decays down a bit. So 3.5% is more what I think. It's a little more conservative. Um, it can deal with, um, if you happen to retire at a very high CAPE level, that's a cyclically adjusted price to equity, or price to earnings rather, which is the Shiller measure. You guys may be familiar with that. Um, so it recommends kind of a lower withdrawal rate if you're at a high CAPE, and you can sustain a higher one at a lower CAPE. Also goes into like, should you pay off your mortgage before you pay it off in sequence of return risk. So that I definitely recommend that if you're curious about it, you want to dig into the math of it. If you don't, then I'd say 4% is a decent rule of thumb to have in your head, but I'd probably be a little more conservative on it. The other thing is Mr. Money Mustache is kind of one of the original FIRE bloggers. He has a nice article here, which is the shockingly simple math behind early retirement. I pulled out the table that he put over there. So it has a couple of assumptions. The assumptions are that your investment returns are 5%. It also assumes that you can live off of the remainder. So that's why when it says 100% down there, you have 0 years until retirement, because that means you can apparently live off $0. So it's not actually that interesting a data point when you're starting out. But just to give you some sense of it, a lot of people say, you should save 10%. If you save 10%, then it will take you 51 years of working until you retire. Um, and that might be a good goal for a lot of people that kind of have difficulties spending less than they make. But it means you got a long way to go. But if you start getting yourself up to 50%, then you only have to work 17 years. Um, so I guess when I was younger, I read the Richest Man in Babylon. That was definitely a 10% rule. I thought 10% was good enough. Fortunately, I ran into people that were um, influenced me quite a bit. That when I was in college, they're like, yeah, 10% is not a good goal, particularly when you're single. You just got your college degree. You're probably making a decent amount of money. You can be saving 50, 60, 70% at that period. Now, it doesn't mean, as you get a family, your expenses go up and that sort of thing. So they'll probably go down. But those savings rates are achievable with a good job. I would say it takes a lot of discipline to do it. So first stage would be the foundation. So I'd say you guys are probably in the foundation phase. So my highest recommendation here is to invest in anything that compounds. So education, like you need to be investing in something that's going to get you a paying job, that's going to work for you, that's going to provide cash flow. So you can do it in a variety of different ways. Education's definitely the most standard one. If you're aiming to be a STEM person, science and technology, lawyer, doctor, those are high paying jobs. That's going to allow you to save a lot of money. Now, lawyer and doctor has a pretty long education phase, so you're not saving as fast. So I'd probably say engineering and computer science is a little bit easier these days. I myself was a chemistry major, but I ended up basically doing computer science type work at a law firm. But setting your education up to something that's going to pay off. So, if you're comparing computer science to art history, one of them is definitely going to pay better than the other. Now, it doesn't mean art history is a terrible idea, but if you're trying to compound wealth, it's probably not a great idea. I would say. Um, the other path that is worth considering is entrepreneurial or both at the same time. If you're trying to make a business or create services and goods that people want, it can provide you a lot of understanding of how the world works. It gives you practice at building things, particularly if you're doing with other people. That's very strong. Practice starting businesses, or even work for small business owners who will reward competency, because a lot of those, like my wife owns a business, anybody who shows up and can do a good job will get promoted and get raises quickly, even if they're young. And you end up learning a whole lot of things for a small business owner, because they usually have lots of different needs, not just do this one thing over and over again and be like, okay, do this, but also we need help over here. And you end up learning a whole bunch of things. Also, like if you started learning skills and say even being an electrician or a plumber, starting that business, you can do very well if you do a good job for your customers. Um, Alternatively, getting good at, say, real estate investing. If you went and figured out how to do renovations, or worked for someone who had a multifamily, and like, how do we take care of this business? You can learn a ton from them. And if you're working with someone good, they will probably let you in on investing rounds over time, so you can be involved in that. If you go that route, you don't necessarily have to go to college, but it's much harder. The college route it's consistent generally. So those two are largely focused on what's going to set you up to make money. But there's a lot of other things that also compound. Relationships really matter, particularly as you get to college. I have like 14 great friends, and most of them I met in college. And it's amazing having that network. It's really important. Mentors are important. So getting to know people um, that are going to help you. I mean, Buffett's advice here is very strong, which is, be around people that you respect and admire, that you think you have something to learn from, that are making good choices. Those things really compound over time. And it may not feel like it right now, and it may not feel like it immediately, but 20 years from now, like I'm friends with somebody I've known since the sixth grade. I'm friends with another person that we've been friends since 15. And then I've got a ton of college friends. And when you've got a 20, 25-year relationship with someone, it's amazing. And they'll be there for you when you need it. So those things compound. They're really important, I think. On investing, you guys are already kind of doing this. First one, max out your Roth IRA. Like, max it out as fast as you can. You're in a low tax bracket right now. You'll pay probably zero taxes. That compounding will work for you so hard if you can get it going right now. Because the early money works the hardest, because it's got years and years of compounding ahead of you, especially even if you retire at 40. If you start at, let's say, 16, I mean, that's 24 years of compounding. If you were compounding at, say, 8% a year, that would be, well, let's say if it was 10% a year, you probably get three doubles out of that. That's tons. So it's just really good. And you guys are already doing a second fact. So the other thing that compounds is your understanding of businesses and how they work and how investing works. So, if you're already analyzing stuff, I heard you guys analyze Rivian and Tesla, and you were looking at Apple. I mean, just getting used to different businesses, getting your circle of competence, what you understand, all of that stuff is immensely valuable. And it's very valuable to be doing when you don't have much money, because you can begin to experiment with it, but it won't cost you that much if you screw up. Whereas as you get older, you can't really have big mistakes as you get to these later stages. But the early stages, you can make some mistakes and it's okay. So it's better to make mistakes on a low amount of capital than a high amount of capital. So that's stage one. If anybody has any questions, like, jump in. I'm just kind of talking here. So feel free to ask any questions, particularly if any of these stages are interesting to you. I can keep going. Obviously, be questions at the end as well. Um, Anybody want to jump in? Looks like probably not. Okay. Stage 2, early career. So this would be like right out of college most of the time. I mean, your career can start a lot sooner or later. I mean, if you go to grad school or being a doctor, your career might not start till you're 30 or so, which extends how long you work. Something to think about in your earlier goals too. So early career, you still need to be investing in that career to increase your experience and competency and earnings potential, because you need the money to increase over time so you can convert it from labor work, even if it's high paid labor work, into equity work. Because as you convert from one to the other people are doing your work for you. And that's the key to building the wealth, because if you work per hour, it's just not going to work. I mean, you'll have to keep working. The only way to get the compounding to pay off is by putting it into equities where they're doing work for you, essentially. So when you come out early in your early career, you want your savings rate to be very high, as basically as high as you can push yourself to, because as I said earlier, that early money works the hardest. Um, at this point, I do not recommend any debt whatsoever. If you're buying a house, mortgage debt is pretty good because of the structure of it, and it provides some inflation protection. Um, and but otherwise, don't go buy the fancy car. Instead of doing that, defer it for a while, put it into equity, because that'll pay off so much better over time. Um, you may have some debt that you accumulated going to college, so I'd recommend getting that paid off. Although a lot of times it's very low interest, so you have to think about that. But in general, I like getting rid of debt other than mortgages, so that my cash flow needs are low. And so, if you're putting your cash flow into the accumulated debt, once you pay off that debt, then you get all of your cash flow plus the excess cash flow that was going towards the debt before. So you get even more to put into investments. Um, in your early career, it has this. It's an interesting time, because your savings will be much larger than your net worth, and it will be that way for a long time. So if your net worth is zero right out of college, then, and let's say you're making $100,000, and you can save 40 or 50 of it, maybe, uh, then your savings rate, if you're saving say 50,000, then that is a huge increase over zero the first year, and that means that has some interesting effects with your portfolio. It means you can be a little bit more concentrated. So, for example, when I was in that phase, I first bought a house. I bought a house, an upgraded house in the financial crisis. But once I had taken care of the house, I was investing in stocks as fast as I could. For the most part, I was buying Bank of America. Now, you guys might not remember, but like Buffett started buying Bank of America at 6. I was buying like 10, 8, 6. And now it's trading at like 40, somewhere around there, I think. I still own it from way back then. But what's interesting about that is, like, if I didn't have a whole lot of money when I was first investing in that, so I might have put $10,000 in Bank of America at 10, and then it drops down to 6 and Buffett buys. Well, I can double that position up easily because my savings rate is so high compared to the net worth. So it allows you to kind of double down on stocks in a way that doesn't really hurt that much and can really pay off over time. Um, so it's an interesting time where you can be a little more concentrated. When things drop by 50%, it doesn't hurt you that much. But later in life, if something drops by 50%, you can't make up for it with your savings, but you can in this phase. And that allows you to experiment a little bit more. It allows you to take care of some mistakes, because if it drops down, and it's still a good investment. Now, sometimes when it drops down, it's a bad investment. You don't put more money in it. But if it drops down and it's going to recover, then you can save your investment by doubling down on it. Um, and that's very powerful in this part of it, and allows you to be flexible. Um, but as you do that, obviously your savings is going to start getting bigger and bigger, and the investment return is going to be bigger. So if I save 50,000 for like 4 years, then I'm going to be at 200. Maybe my investments have gone well, and I'm at 250. 50% or $50,000 is still significant relative to 250, but I'm starting to feel it a little bit. And that kind of moves us into stage 3, which is when you're more established. So your earnings from career should be providing pretty decent income. So you've been investing in your career, it's making more money, you're getting raises, and they're still coming in, but maybe they slow down a bit because you kind of have a very fast rise initially if you've proven yourself, in my experience. Um, so at this point, your net worth is a multiple of your savings, but the savings amount is still significant. So, 10 to 25%. So when I was saying you're saving 50,000 and you're at 250, you're talking about 20% there. So it's still important. So if you think about your increase in net worth is the investment gains plus your savings rate relative to it. So a decent year in the stock market is 10%. Like the average run of stock market is 9.6% over the last 150 years or so. So 10% is a good kind of benchmark to think about. So if you're 250 and you get a 10% year, that adds $25,000, and that's pretty significant. But $50,000 of savings is twice that amount. So your savings is still huge compared to the returns. Um, so that one, you still feel very powerful with your savings. You're putting it in as fast as you can. It still feels exciting every time you deposit that money into your investment account. You see it go up. It feels really good. But as it gets bigger and bigger, that effect decreases. At this stage, at the stage 2, I'd say scrimp as much as you can, be as cheap as you can. Um, at stage 3, you've gotten a few raises. At this point, I would say live at least a notch or two behind your means. So, if maybe I was making 100 out of college in a STEM career, but maybe I've gotten to 200. So what I might have done. So if I was saving 50,000, I was probably living off 40 because of taxes. Um, so if I get to 200,000, I get to upgrade the spending some, but I want to upgrade the savings just as much. So what I always did when I got a raise is I upped my savings, and then I was like, how much is left over now for me? So I'd give myself a little bit of a raise on my consumption, but I would always give myself a raise on savings first. So I would say, like, what is the most amount I could save that's reasonable? And then I'm going to give myself a little bit of a consumption raise so that I'd feel good about the raise, and a little bit of reward for it. So if I went from saving 50,000 at 100,000 income, if I'm making 200 at stage 3, then I'm probably trying to save, I don't know, 100,000 or so. But that means that my spending has also gone up quite a bit. Effectively, I was able to double both spending and consumption there. But you can be as aggressive as you want, and the more aggressive you are, the more it's going to pay off. But that does allow you to reward yourself and not defer all consumption till you're dead, which is not very useful. But your net worth is still building quite quickly because you've been upgrading your savings at the same time. The next phase is where it starts to get a little more interesting. I'm calling this the coast phase, and this is where your savings. Got it. This is where your savings rate stops having a big impact on your net worth. So the reason is, let's say I'm saving $100,000 a year now after those raises we just talked about, but I've gotten my net worth up to, I don't know, 4 million. So 100,000 divided by 4 million is 2.5%. So this is, here I had less than 5%. So the savings still matters some, but it's only increasing your net worth by 2.5%. Now that 2.5% is going to compound over time, but this is later in your career, so the early money is doing most of the work for you. Most of your returns are going to be driven by investment gains, not work at this point. But you're not ready to quit yet because you need it to continue to grow. At this point, I would say consider allowing your spending to be just behind your means. So you're still saving, but you're maybe not hitting 50% anymore because it's just not moving the needle like it used to. Alternatively, instead of allowing your spending to increase, you could start cutting back your working hours. The important phase here is to aim for one more double without withdrawing from your investment. So you're close to the phase where you could retire. You probably could retire at a lean phase here. But if you can give yourself one more double and take the pressure off or allow yourself to spend more and enjoy more, then you kind of hit escape velocity. And I think escape velocity is very important in this regard because the way compounding works is either it's going to work great or it's going to not work. So you want to make sure that it's going to work great. So don't be close here. Be conservative and go for the kill. This is what I would say. Um, so once we're at stage 4 here, stage 5 is pretty straightforward. It's retirement. So you've got your last double, you've coasted out. But retirement has its own set of trickiness to it. The finances get tricky because you don't have any income. Downturns start to hurt a lot. Like if you had the pandemic happen while you're retired, you're facing a 20, 25, 30% drawdown in a month. And the world feels very scary and you don't have a job and you don't have income to take care of it. So you have to kind of brace yourself for those sort of things. This is why I think, being conservative with your number, having a 3.5% withdrawal rate, or maybe even 3 instead of 4%, a little bit of cash might help. I definitely recommend going back to that series of blog posts I was talking about on a safe withdrawal rate. It talks about that a lot. You guys might not be interested in it now, but it is something to think about over time. The other thing about retirement is for sort of obsessive people, like probably a lot of us are here, that are focused on goals and want to get things done, retirement is a little bit scary. Because if you built your whole life around, I'm going to retire early, but you didn't think about what you do when you retire, then all of your meaning sort of disappears because you're like, well, I retired. I saved all my money. I did all the things. What do I do now? So there's a great Reddit post about someone who had built his life around savings, and it didn't really make him feel good. So his advice was build the life you want, then save for it. So try to make sure that the life you're living, and this kind of goes back to all the other earlier stages, make sure that the life you're living is something that you want and not just I'm sacrificing everything in order to retire, but I don't have anything when I retire. You don't have the friendships you wanted, you don't have the hobbies you wanted, you don't have the skills you wanted, that sort of thing. Because you need something to fill up your life. And you need to have something to look forward to, really. And in this phase, and it's quite common for depression and a period of adjustment to happen and to be normal. And that's why I'm saying be prepared for it. The other thing that happens with a lot of people that are sort of, highly driven is they do a hobby or a second career, but they take all the pressure off of it. And most of the time they end up being almost as successful as they were with their original career. But they're doing it in a way that just doesn't hurt at all. And that's pretty interesting. Maybe it's possible to do that a little sooner. You could even do it during the coast phase. But it's something that appears to happen quite often. A lot of these fire guys make more money off their blogs about early retirement than they did in their first career. So those are all the stages that I came up with. I'm sitting in stage 4 right now and a little bit scared of stage 5, honestly. So that's where I'm at. One thing that my partner, Jeff Hood, he's a partner in a hedge fund. He's at a higher net worth than me. He wanted to make sure that I talked about wealth transfer. So if you're building wealth, then you're going to have a wealth transfer at some point, and it's going to go either it's going to go to other people than you, because everyone dies and they don't get to keep it. So obviously you've got your own choices to make on that. If you're planning on passing it to future generations, at some point in there, you need to think about estate planning. And the most likely time for that to happen is during the coasting stage. Right now, you can give 10 million away tax-free, I believe. That may decrease over time. So if you're planning on trying to transfer more money than that, then you need to start setting up trusts and talking to lawyers. If it's going to your children or your relations, or people you're specifically picking out. The other choice is to give it away to charity, like Buffett does. You know, the giving pledge. Personally, that's what I'm planning to do. You don't really have to plan so much for that, because there's just not much to go in. You write a will and you say this is where it's supposed to go, and then it does. On that note, don't forget to prepare a will sooner than you think. Stuff happens, particularly as you're building wealth. I didn't take care of it till I was a couple of years ago, but I definitely recommend thinking about it. I think that is about it on the time, so we can move to the Q&A, which we have, but I tried to kind of go through that pretty quickly. Hopefully it wasn't a whole bunch of redundant stuff for you guys, but I'm open to questions. The other thing I was going to mention to you, I have a spreadsheet that I've been tracking. This is something I recommend that you do. So I started working when I was 16, and this is how my net worth went over time. So you can see net worth does a whole lot of nothing for a long time. And the savings rate really matters here. So you can see how much the net worth is changing, but then you can see that portfolio returns start taking over. So like at this point, this year is ridiculous. So like this is nearly a $2 million increase in 1 year, but it's just compounding. It's just your equities working for you. I recommend doing this just so you can keep track of what things do. I have little notes to myself over here on the right that just kind of tell me what was going on for me that year. And you can see net worth only went down 1 year, and that was because of bad investments. This is where you can save like $200,000 in a year, and still your net worth goes down when your portfolio is big enough, because a bad downturn will just eat your savings. On the other hand, if you have an up year and you save it, it looks amazing. Anyway, I just thought I would show that to you. I recommend keeping track of it. I was paying attention to how much money I was making, how much I was savings, where the retirements were, what the debt looked like, that sort of thing. So with that, I'm going to go ahead and stop it. I think we hit the 7:45 mark. So please feel free to ask any questions. Hopefully that was useful.
Yeah, if you have any questions, feel free to drop those in the chat. Just unmute your mic.
Chat back up. I didn't have chat while I was sharing screens. I'll post. I'm gonna put some links from the talk so you guys can click through them if you want. But go ahead and ask questions if you want while I'm doing that. This is that's the Trinity study. Any comments on international investing? Well, I mean, we're a go anywhere fund. So I'd say international investing is a little trickier. The regulatory regimes are different. The government's different. I mean, like if you've been looking at what China's doing, then you can see a lot of regulatory stuff coming down. Even in the US, though, there's probably going to be regulatory stuff coming down in tech. But China's a little bit more extreme with it. India has its own pitfalls. I know a ton of Indian investors, and I think India is probably very exciting, but you got to really watch out for stuff. But I don't have a lot of experience there. I usually let other people do the investing for that. So I happen to own Fairfax. They do a lot of India investing, and I happen to think they're cheap at the moment. So, but I've owned stuff in Hong Kong, England, on the London Exchange, fiat over in Italy. So I think there's good stuff out there, but you need to practice it, and know what the regimes are like. I would say. Let me see. I'll go grab some more links right quick. Any other questions or follow ups there? What kind of stocks or indexes did I invest? So in my when I first started, I did passive index funds before I really started looking into it. Um, After that, mostly individual stocks. I made most of my initial money on banks and insurance companies. Berkshire Hathaway is the quintessential value investor stock. So obviously I was doing that. Then you had Markel and Fairfax. Those are kind of the baby Berkshires, so-called, although Fairfax kind of lost its sheen lately. Um, Markel's still doing fine. And then there was a lot of banks. So I was pretty heavily exposed to financials, which has been not great over the last, say, 6 years, because tech has just been amazingly strong. Um, I'll get to that question in a minute. I think the big tech companies are amazing companies. We have a lot of exposure to them these days. I have huge exposure to alternative asset managers. So you're talking about like Brookfield, Blackstone, Apollo. All of them have huge tailwinds right now in a low interest environment. They've done extraordinarily well. I think all of them have returned like 20% compounded for 20 years. They're all saying it's the best environment they've ever been in. So I like alternative asset management quite a bit, although that some people don't like it as much, but I happen to like it. Um, so that's what I'd say about stocks that I've invested in. Specific sector I like more than another. I think I covered that probably. Other than stocks and real estate, any other investment vehicles? I personally do not invest in anything that doesn't have cash flows. So gold is out for me. I don't think it's interesting. I think almost nothing about crypto. I know people are making millions and millions of dollars off crypto, but I don't care. I invest in what I know, and what I understand. And what I understand is how to value a business based on the cash that it produces. This is a very Warren Buffett answer, but it's what makes sense to me. Yeah, I have to think about that one. Other than stocks and real estate, that's really what I would recommend. That's not to say you can't do other things. Other people do very well with other strategies. I'm not saying don't do that. It's just what I understand. That's what I recommend. So, um, you said invest in real estate using leverage. Yeah. So, I think real estate requires leverage to do well, unless you just kill it. So, and the reason that real estate's nice with leverage is because you have a fixed cost structure, so you get a 30-year fixed. That is amazing for inflation. So I'm going to sort of answer both questions at once. Having a mortgage is amazing inflation protection, because theoretically in inflation, asset values go up, so the value of your house would go up. Theoretically your income would go up because you need to get paid more in a higher inflation environment, but your payment to the bank does not go up. And that mortgage is allowing your equity returns to get much bigger. So let's say you had a $100,000 home that you put 20% down on, so you'd avoid the mortgage insurance cost. So you put $20,000 down, and the bank gave you $80,000, and you're paying a very low amount for that $80,000 right now. Let's say that the house goes up a modest amount. Let's say it goes up 10%. So 10% is not a big increase in the real estate value, and it's nothing to really write home about, unless it's within a year. But 10% means the house is worth $110,000, right? But I still only owe 80,000, and I put 20,000 in as equity. So that is a 50% gain on my equity, even though it's a 10% gain on the house. This is why people get very, very rich in real estate, because if it's working with 5-to-1 leverage, or 4-to-1. You're getting multiple of 5 off of it. So that's the power of real estate. Without the leverage, it's not as interesting. Um, but it being a fixed leverage, all you have to take care of is make sure that you have the income to cover that payment. If you can cover the payment, you're not going to get caught in a downturn. So the only way you lose money is in a downturn, you have to sell. So you have to prevent yourself from having to sell. That's where, if you take leverage, that's what you have to make sure of. If you do leverage and you have to sell, then you can wipe out everything. So I don't generally recommend leverage, but if you're doing real estate, it's kind of part of the game. I personally don't lever up as much on real estate. I try to put a good down payment in. We have a house, it's got a 50% loan to value. So I'm not up at 80%, even though I could be. I like having a lower cash flow need, even if that reduces my returns. It makes me feel safer. So that's where I pick. I'm personally more interested in stocks because they're liquid, and you generally get better deals because markets panic more than individual homeowners or individual business owners do. Um, let's see. High inflation period. Other than that, I mean, it's difficult. Typically, the best returns for inflation is equities. That's your best protection because, and in companies that can handle inflation, you want lower capex companies. If you go read Warren Buffett's How Inflation Swindles the Investor, that's what you want to read about equities and high inflation. Do you do options? I have done options. It is very interesting. I typically will, I try to make sure any option I do is over a year. I want to buy myself time. I don't do it with a high amount of money. And I typically do it with a stock that I know very, very, very well. So, for example, I owned Fiat Chrysler for about 5 years before Sergio died, sadly. Um, and that stock would just go up and down and up and down. And I had a very good idea of what I thought the intrinsic value was. When it went down to a low price, I would sometimes throw in some options, but it wasn't high relative to my net worth. And there's a lot of studying that you need to do about options to really understand what's going on. Um, I have a couple of papers that I posted on the Austin Value Capital website. I will go grab it right quick. I write essays every year, um, and I've written about options a couple of times. Um, so um, there's puts and takes. That's more about hedging, and there's also the cost of leverage. That's the one I really recommend if you want to understand options. I talk about it in a very different way than most people do. You can also go read options stuff where they'll talk about more about Black-Scholes and intrinsic value and extrinsic value and that sort of thing. And it's good to understand that language too. Instead of bonds, do you recommend income ETFs? I personally don't. I'll be honest though, I don't really understand how bond funds work very well. I kind of, if you own a 30-year bond, you don't have to take short-term risk on that if you don't sell it. But a bond fund is having to buy and sell bonds all the time. So I feel like it's actually taking on more risk than it appears to take on. But this is a relatively uninformed opinion, so don't put much weight on it. The other thing is there's a lot of good yielding ETFs that may be doing high yield bonds, which used to be like 12% returns, but in a low interest environment, you're only getting like 6. A 6% return on high yield bonds is just not something I'm personally interested in. But again, I'm not really a bond investor. I do it occasionally. If there's like a very cheap bond when I can get equity like returns, I'll do that sometimes. Or preferred shares, I sometimes do that. So I'll stop doing that. What stocks do I recommend? Um, well, I mean, you need to invest in stocks that are something you understand, something you can hold when it goes down. If you're relying on someone else's expertise for a stock, it's really not going to do you much good. You need to be able to, I mean, it's a Munger quote, you need to be able to handle a 50% drawdown and not lose your mind and feel safe with it. If you can't do that, then don't be in the stock. So you need to understand it well enough to do that. Not to say that sometimes bad things happen, but you need to understand what you're doing and be able to react with a cool head. Um, but I'm invested in a variety of stuff, and I mean, the alternative asset managers I think are worth looking at. So feel free to look at it. Do I think there's a bubble right now? It's tough. I don't know. Low interest rate environment means stocks should be up a lot, and they are. We're in I guess the term is TINA. There is no alternative. You're stuck with it. I personally think long-term future returns of stocks will probably be much lower than they used to be. I kind of think it might be 5%, but I've been thinking that for a while, and it's been compounding at 15% for a long time. In general, something to think about, you actually want stocks to be lower. You make more money when stocks are lower for a variety of reasons. Like, let's say you're invested and a stock goes up 100% and you're still making money. That means every dollar you put into the stock market makes less money. So you actually want it to be low and stay low until you retire, because you're buying more of the businesses every time you buy, as opposed to a high price. So while the price going up is nice, it means if you're continuing to invest, you're buying less of the company. So that's sad. There's a nice story from Buffett about hamburgers. I definitely recommend that, but there's only 2 minutes left, so I'm not going to go into it. So that's that kind of answered all the questions that came up. I'm happy to answer a couple more, but I think you were going to make some announcements, right?
Yeah, thanks so much, Joel. Hope you guys found this helpful. But before you guys leave, if you don't know already, ICOA, which stands for Investment Clubs of America, we are an organization generally for school investment clubs. So if you're a high school student who's interested in starting an investment club at your school, or if you already have an investment club, you can register a chapter with ICOA to get access to our library of resources, events, competitions, bounce ideas off other clubs, and much more. So I pasted the link to that in, let me quickly hit that link. Yeah, I'll paste that link in the chat. But if you're interested in starting a club, or if you already have one, like I already said, it's a really quick process and a lot of benefits to join the network. So let me just paste this in the chat right now. So you can fill that out right there if you're interested. But yeah, with that said, I want to thank you guys all for attending again. We'll send out the recording through email. And thank you, Joel, for coming out and doing this once more.
Yeah.
Yeah.
One quick thing, I post a lot of compilations, and I just posted a link to it. Like, I have a compilation that has everything Buffett's ever written in date order, and it's bookmarked, and Charlie Munger as well. So if you guys are interested in that stuff, check it out. So I just posted a link to that as well.
All right. Yeah. So yeah, I guess that's the end of the event. Hope to see you guys next event, whenever that might be, and have a great weekend.